Hello and welcome to This is Property with John Pidgeon and Rachel Crew. Today, special guest on the show, Darren Wilson, who's the General Manager of Property Sharemarket Economics. And if anyone's heard any of their work, you would understand that they talk about an 18.6 real estate cycle. Now, it's an idea that's been popularised, is that a word?
Yeah.
By researchers like Homer Hoyt in the US and later expanded on by Fred Harrison and Phil Anderson. And Darren works closely with Phil, who argues that property markets tend to follow roughly an 18 to 20 year boom-bust rhythm influenced by land speculation and credit availability. So we've had Darren's colleague Kathy on the show probably a few years ago now, so feel free to go back and listen to that episode as well. But pleasure to have Darren on, and I'm excited to ask a couple of key questions, and I'm sure you are as well, Rach.
Yeah, great. That episode was 344. If
344, there you go, episode 344. So thank you for that, Rach, and let's get on with the show. Welcome, Darren.
Yeah, g'day, John, Rachel. Thank you very much for the invite. Looking forward to today.
Absolutely, yeah. So I enjoyed the conversation or the chat that I had with Kathy in episode 344. Very passionate about cycles and I suppose the cyclical nature of Australia. And I suppose she's actually a good friend of mine, and she alluded me to this 18.6 year real estate cycle probably 10 years ago. And I was like a meerkat, Rach. I'm like, it's like the ears went up. I'm like, what's going on here? How come I haven't heard about this before? Yeah. I need to dig deeper. So, yeah, fast forward to today. Darren's going to expand on this some more and how fitting it is in 2025 as to what potentially is ahead of us. So, Darren, let's start by maybe chatting about how you came to be involved in this research.
Sure, yeah. Well, in brief, I mean, my background was a public servant. I actually worked in the ATO, and I joined the ATO to work out. I always wanted to pay less tax. I thought, what better way than to work for the source, right? And I discovered Phil's work. It was about 2012, and he just started some form of collaboration with a company in Melbourne. No longer there. They were called Port Phillip Publishing. So I bought his book in about 2013, read it, and that was it for me. I had to go to every single meeting that Phil held across Australia. I ended up doing some volunteer work for him, some research and stuff like that, just to help further and broaden my knowledge of both stock and real estate. And anyway, I think it was 2019, Phil and Port Phillip parted ways. Phil then ran his first class after that. I attended it, and he approached me and said, look, Darren, I know you understand this stuff and you've done some volunteer work. I want to start a new business called Property Sharemarket Economics. Would you be interested in volunteering some time? So, of course, I leapt at that, and one thing led to another, and I basically went part-time with ATO and then just left and become full-time involved in growing the PSC business. So that's how I get here today.
And Property Sharemarket Economics is a subscription base coming to you with monthly bulletins, monthly updates on how Phil and his team see the economy's tracking. Is that essentially what it is in short?
Yeah, multi-tiered. So we have a free list, then we have the Boom Bust Bulletin, which is our monthly sort of introductory service. That's what I edit. I edit both the weekly newsletter and the BBB, as we call it, which is designed to give people a head start in understanding the many different concepts involved in land economics and cycle timing. And then, as you mentioned before, John, you've got the full PSE membership. So yeah, it's a multi-tiered one. The idea is to bring these people up through the systems, educate them on our work, give them a solid grounding, and then if they so choose, they can become full-time members.
So let's talk about this 18.6 real estate cycle. Can you explain for the listeners, bare basics, how we believe it transpires and how history has a habit of repeating itself?
Yeah, all right. So bare basics. There's two reasons why it's 18.6. One is esoteric in nature, probably outside the scope of this. The other one is that for 220 years now, the United States land market has shown a remarkable propensity to repeat. Now, it has a real estate cycle that in that time frame averages no shorter than 17 years, but no longer than 20. So it averages out at about 18.6. So if you're going to describe this cycle to someone new, you call it the 18.6 year real estate cycle, even though it's regarding the average length there for the US land markets. So that's basically the whole cycle research is based on that. And in fact, you can make a good case to me that it should be called the economic cycle, because banks and finance world now are so intertwined with the land market that it's almost indistinguishable, you know. So, but we call it the real estate cycle. I mean, Phil Anderson's book, The Secret Life of Real Estate and Banking, as well, is called that. So I think it's easier for people who are new to the research to grasp it. Yeah, that's the one.
Let's break it down, because there's four phases essentially, isn't there, of that 18.6 real estate cycle. Can you explain that and how that works, and maybe give an example?
Yeah, sure. So if there's such thing as a formula, it would be 14 plus 4 equals 18. So I'll explain that. So the 14 indicates 2 7-year periods of rising land markets in the US. Those 2 7-year periods are interrupted by something we call the mid-cycle recession. It's generally 6 to 12 months in length. Our one for this cycle corresponded with the COVID lockdowns, which I hope we never go through again. And then at the peak, you usually experience something 3 years, maybe 4, depending on just how much speculation has happened before it, of land prices falling down. So you have 14, 7 plus 7, plus 4, which is generally 3 years at the end, plus your 6 to 12 in the middle, and that constitutes your broad 18-year real estate cycle. So you mentioned an example. So as I said there, during COVID lockdown, we were telling our members in December 2019 to expect a slowdown. Certainly not a global pandemic, mind you. We're not that we're not that prescient with stuff, but the economy was starting to slow down. It was in line with the mid-cycle recession that we were expecting. So our members were prepared for it. Certainly the pandemic was an additional layer that we didn't expect, but I think it shows, very briefly, a good example of how our research can help our members with time in their investment decisions.
Now, the pessimist out there would say, okay, through this period of pandemic, there were markets that went up, exploded, and there were markets that stayed stagnant, and there were markets that retracted. So what's your, I suppose, response to something like that?
No, I think that's a good point to bring up. It generally relates to, in a mid-cycle recession, what do governments most favour to get the economy back moving again? Now, in places like the US and Australia, and to a lesser extent the UK, the answer is always property. Protect land values. So here in Australia, you know, we had the government come up with means and incentives driven by the banks to cover the monthly mortgage payments for, you know, the vast majority of workers. So that was designed to make sure we didn't have a rush of defaults on bank loans. We didn't have tens of thousands of people having to leave the community at a time when we're all locked down, mind you. We all had to stay inside. But there are other countries where perhaps that wasn't the first thing that governments wanted to do. And the pure shock of a global pandemic did have further ramifications on land markets. Suffice to say, each market is different, John, but the outcome was that after the initial shock, they bottomed and then they all started rising again, almost in uniform. And to this day, that has been the case.
So where in the cycle are we sitting at the moment, Darren?
Okay, excellent question. So what you're asking me, Rachel, is a question concerning timing. I can tell you unashamedly You will not get the timing of the cycle if you follow Australia. It's actually only one market you can do it. It's the United States. The US leads the world into and out of every 18.6 real estate cycle for over 200 years now. So for us as a business, it's the United States that must be the center of our research because that's where we get the timing from. So from the US perspective right now, we're in year 13 of those 14 years of rising prices. We expect probably this time next year, quite possibly, probably, land markets in the United States will have peaked. Now, if you're in Australia, you might think, well, that's not much use to me. I don't invest in the United States. But you might be interested to know that if you understand the real estate cycle from the US point of view, you'll know that Australia actually has a head start on what happens over there. And so we could expect the Australian land markets, broadly speaking, take maybe our top 2 or 3 capital cities, 6 to 12 months after the US peak, they'll do something very similar as well. So that gives people who study the United States an enormous head start in trying to time something that might happen 6 to 12 months in advance. But for your question, Rachel, that's where we are. We're at year 13. We've still got a little bit way to go, but the end is not.
And what will happen at the end of the cycle?
Well, the world won't blow up. Netflix won't cancel.
Oh, that's a relief.
Yeah, you'll look out your window and pretty much the day after the land market tops, absolutely nothing will change. It's one of the advantages of real estate. Nothing happens quickly. We're not talking about a crypto market or, speculative stocks that can move 50% in an hour, which we've seen already, Real estate tends to be a good old slow moving sort of market. So the stats that we'll be relying upon, they're lagging indicators. So generally, we won't be able to confirm it probably till about 2 to 3 months after the actual event that there looks like there's been a topping out. But at first, there will be very little change rates. You won't notice much at all. But the key will be the stock charts, because those stock charts of the leading US property developers will show very clearly that their earnings are about to drop significantly and that market makers are going to price that accordingly. And that's your first clue.
So when you say stock charts of say developers, for example, is that because there's a credit crunch, they can't obtain lending, or is there an oversupply of land, or what's happening to essentially cause that?
Oh, a little bit of all of that, John, to be honest. It does get to the point where it makes no business sense to continue to bid land prices higher because they just can't make the profit margin that they once did. And then that leads on to obviously the credit question with it, because obviously these land developers do use a lot of credit to purchase this land well in advance of developing it. If the land price basically absorbs all the credit that can be possibly lent against it, then that's it. You've hit that wall of development. And as I said, people who live and breathe analysing stocks, they're generally the first to discover it. We call it the price discovery mechanism of stock markets. And they'll very quickly understand that that's happened, that they've reached capacity, that it does not make any more business sense whatsoever to continue to push the land prices higher because there's no profit-driven motive to do so. And they start pricing the stock prices lower. What we're looking for in this case is what we call a lower top. That's the first indicator that things are about to turn down. At
the moment, I feel as though, Rach, we're in an environment where, literally had an interest rate cut yesterday. Rates are well down on the previous sort of 12 months, 2 years. We've got a high demand for property, real estate in Australia, and we've got an absolute lack of supply, catastrophic levels that I haven't seen in my short time in life. So when we've got access to lending the way it is now, right, people can borrow money quite comfortably, and we've got massive undersupply of housing in Australia, and a massive demand because people love real estate and people want to buy their own home and investors want to invest and all these things. We're probably guilty of sitting here saying, how can we see any crash on the horizon? And I'm wary to use the word crash, but how can we see this slowing down at all?
Well, that's you've actually highlighted one of the keys of it, is that the reason why it's such a massive shock to the system is because no one sees it coming. Now, unless I'm mistaken, I don't think we've got 25 million members of PSE. We have a few thousand. So 99.9% of the population aren't privy to our research, and they're never going to see this coming. I also push back, and I understand the sentiment. I really do. But I do push back sometimes. I think we need to be more nuanced when we talk about undersupply. Let me explain. If you're talking there's an undersupply of brand new greenfield developments coming to market, I agree with you. And for many different reasons. One is that, we've had an absolute carve out of, developers that have just basically packed it in and no longer in business. But if you're talking undersupply of existing homes, you will find in a few years from now just how many, and I'm talking tens, possibly hundreds of thousands of units and houses that have been deliberately kept off the market that will flood when things turn south and just exacerbate the downside for land prices and the selling pressure as well. I mean, I live here in the south of Canberra. There are dozens and dozens of houses here, and these are like, some of them are McMansions, some of them are 5-bedroom sort of places and stuff. In the 8-9 years I've lived here, I've seen the lights on inside them at night, maybe once or twice. They're just empty, just sitting there. Those types of properties, when things get bad and the owners of them decide it's time to cash in, they'll get released when land prices start to really, really fall, and they just exacerbate things to the downside. So that's why I try to be a little bit more nuanced, even though I understand your sentiment, John, precisely about why you would say that. And I think also because the media narrative, every single day we are told we have not enough supply, we have this. But I tend to look at things a little bit more nuanced and a little bit more deeper than they do.
So when you say deliberately kept off the market, are they investment homes? Are they owner occupiers? And why would they need to sell when it's a downturn or a retraction?
I'm not sure who owns them specifically, because I've actually never had a chance to talk to anyone either leaving or entering them. I just know in my travels around my local area, for instance, and also if you go to Sydney and Melbourne as well, a lot of times, you look at these brand new apartment towers and stuff like that, and only half the lights are on. So, I mean, it's a combination of things. They might be Airbnbs, for instance, although I don't know why you'd have them here in Canberra necessarily. They could be owner-occupier, so they could just be kept. But there's also a very quiet but large swell of international buyers that love to buy Australian property and hold their wealth here as well. And I think that, they're just here for the capital gain. And when it's obvious that that capital gain is fast disappearing, they'll sell.
Yeah, so we have had a pretty steady market in Australia for the last 30 years. Do you think that's going to change dramatically in this next cycle? Do you think there's going to be a sudden drop in the market?
Well, the Australian market's funny. I mean, let's be honest. It's a bunch of capital cities really, and then a whole heap of sort of empty land. And if you look at Australia, I view, Sydney, Melbourne, Brisbane, Adelaide, etc., their own little nation states. They all move to the beat of their own drum. They like to do their own things. They tend to either lag or follow, each other a little bit. So when we talk about what could the potential falls be, well, regardless of what market you're studying, it's predicated largely on one single fact, and that is how much speculative credit is created prior to the peak coming in. Now, at the moment, there is a lot of credit being created in Australia from traditional banks to put into property. We believe private equity and credit are also pumping a lot of money in, but they go to great lengths to hide the amounts of that. But let's assume it's quite substantial. So historically, Australian property as a whole, every time we have a significant downturn, I think the average fall is like 12% across all capital cities. Maybe sometimes 15 is particularly bad. So we're not talking about 50% or 60%, some sort of Armageddon scenario. But what I would expect is in these last few years here in Australia, those areas that are on the margins and getting bid up the most will suffer the most egregious losses compared to the more traditional big capital cities that we've got here in Australia.
Yeah, interesting stuff. It has my mind ticking over in all sorts of different directions. I don't know about you, Rach, but let's take a break and we come back. We want to talk about maybe what us as individuals can be doing to mitigate the downside of all this.
This is Property is brought to you by Sphere Home Loans. Sphere Home Loans is a mortgage broker that helps our listeners all around Australia. So, if you want to get into your first home sooner, looking at upgrading, an additional property, or want your current mortgage reviewed, just search Sphere Home Loans or click the link in the show notes, and their dedicated brokers will be able to help you wherever you are. If you are, however, after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. That's moneypodcast.com.au and click Get Help.
Darren, you've alluded to, I suppose, the data and the research behind it. I look at the last major, I suppose, downturn in Australia, GFC. Yeah. So we do our simple maths. We add 18 years to GFC, and that puts us at about 2027, I think, if my maths serve me correctly. So in Australia, they talk about America and the flow-on effect. Is generally Australia 12 months behind the US? Is it 6 months? Is it straight away? Does it take some time to catch up? And is 2027 about right?
Yeah, that sounds right. As we get closer, we should be able to really narrow down our timing there. But as a broad sort of time to start looking for it, 2027, I think broadly sounds pretty good. May be different in areas like southeast Queensland because there's a little thing called the Olympics coming up in 2032. I'm not sure Queensland government can cancel that. They're going to have to go ahead with it whether they're broke or not. So
Victoria did it, so there's no reason why Queensland can't.
Yeah, that's it. But we don't have much. I mean, Sydney had the Olympics in 2000, and that certainly did affect both before the Olympics and after its own real estate market there, quite markedly. So I assume I'm going to say that, Brisbane will have a slightly different experience come the end of the cycle as opposed to all the other capital cities at the moment. But yes, your timing is pretty much 2027. I'd start to look for signs that things are starting to top out here. And then, when we get closer, start to really focus in and try and get an idea of maybe a 3-month window where we think it might peak.
So that probably brings us to our next point of there's markets within markets. And if you've alluded to that, they're their own sort of identity when it comes to the performance of them. But like there's 11 million properties roughly around the country, and they've all in isolation, they've all a different type of asset. They're a different location per se, and they're a different value. So you've really got thousands of different markets within the country. So someone that's really wanting to sort of articulate this has a wow of a time trying to understand it because there are so many different types of markets, both asset type but also location geographically.
Oh, yeah, absolutely. I mean, local knowledge is the best knowledge. If you can find, good, reliable real estate agents, mortgage brokers, conveyancers that know their market well, absolutely, leverage their experience and their input on how the market is performing. Because as you say, we're talking wheels within wheels within wheels with markets. The 18.6 cycle is not a one-size-fit-all mechanism for any area. It doesn't work down at the suburb level, you know what I mean? The more traditional things like supply and demand and infrastructure building and stuff like that, they're more the drivers at that lower level. What we talk about with the cycle is a macro top-level view looking down on the whole economy, you know what I mean? So it's a far more broader tool to use as opposed to, say, normal investors that need to use the usual investor tools to identify and hold, good yielding, high quality properties at a good location.
If I'm a person out there that's interested in this and just on a daily, weekly, monthly level, just looking at various indicators, and you spoke about the lagging indicators, so we just can't wake up, as you said, to tomorrow and it's like, oh yeah, it's happened, it's occurred. Are there any telltale signs that the average person out there can look for to say, yeah, I can actually see a bit of momentum building here?
Yeah, well, we generally advise our clients. They're a mix of stock market specialists or real estate or business owners, and really to make the most out of the cycle and the knowledge, you actually need a foot in all camps. Even if you're not perhaps predicated to the stock market or real estate, it's actually very beneficial for you to know about those markets. So, as I mentioned earlier, one of the great ways to monitor what's going on is build a watch list of the biggest, most liquid property developers on the stock market and just start to follow their price. And in particular too, if you study the financial news as well, the biggest property developers do get a lot of media attention. Have a look at the news when it breaks and then bring up the stock chart and see what the stock's doing, because quite often if the news is bearish, prices are going up. That gives you some idea of actually where the smart money's going with this stuff. As I mentioned too, with the United States, we have noticed right across a broad selection of stocks there, the biggest US home developers, your D.R. Hortons, your Tolls, your Lenacor, they've all made tops late last year. The prices have been falling, but they do seem to be bottoming out a little bit. So if our research is correct and we have our timing right, what we should expect then for those particular companies in the next 6 to 10 months or so is they'll actually move higher, even if the news on them becomes worse, because history shows us that they should make a final, what we call a lower high. So the stock price will rise, but it won't quite hit that all-time high it did last year. And that's your first indication that, the market makers are starting to price in lower earnings, and that is a direct consequence. The land prices are too high and they can no longer secure the credit they need to continue to maintain a viable business.
So moving on to what we can do to prepare as individuals, right? I think when I'm hearing this and saying, okay, if this is going to happen in the next 2 years, how do I change my strategy and my approach? And I sit here and look at the foundations that we teach, and I don't think a lot of this changes. Like, the first one I would say is understand your cash flow management, what's going in, what's going out in your personal life, and having emergency buffers. You're always having them for the next 100 years, aren't you? Yeah. The second one is long-term planning. What do we want? What do we do over the next 5 to 10 years? What do we want in our life? And when we're building a portfolio of wealth, it's a long-term approach to investing, whichever way we look at it. There might be a small component that is short-term, sort of, let's have a speculative play on this sort of thing. The third thing is probably no taking on of any bad debts or any impulse buying as such, right? I'm not just going to go and buy a stock for the sake of it, or go and buy something I don't know anything about, or go and take on more debt in my life that's not going to give me an income or a wealth building exercise, right? So if I'm doing all that, it sounds as though the retractions of, like anywhere from 8 to 12%, if I've got my cash flow buffers, if that actually plays out in all of my portfolio, I can see myself through that, which I think is the number one aim, is to be able to say, well, if retractions occur and the ups and downs in real estate are evident, and that happens everywhere, and you've got to prepare yourself for any downturn, I know that I'm covered because I'm cash heavy. I'm thinking long term. I'm not emotionally wrapped up in tomorrow. I know it's a long term play, and I'm just going to wait for it recover. Is that I suppose, a naive way to look at it, Darren?
John, there's so much I could say about this. I could talk about this for hours because it's such an involved sort of subject. So firstly, okay, whilst I can't give tailored and personalised financial advice, so there's that. Yeah, that's right. Your line of thinking, from my point of view, is correct. Now, we call it a cycle, yeah? Well, a cycle has a beginning and a cycle has an end. But then it begins again. That's why it's a cycle. So what you've got to do is you've got to think about not only the here and now. We know we're coming close to the top and there's going to be a reaction to the downside. But you need to start also laying the groundwork for when the next cycle comes. Because inevitably, things will bottom out and they'll start to go up again. So, generally speaking, think about today while the banks are still your friends. They're not putting pressure on you, and I'm sure for overdue credit cards or the mortgage payments, which hopefully people are getting a little bit of relief if they contact their bank and ask them to pass on the full rate for them there. We've got a window of calm before the storm hits. So start planning now how your portfolio is going to look, how you're going to protect yourself. So simply look at it from the bank's point of view. What makes the bank happy? Well, can you guarantee that you can still pay your mortgage bill on time? That's the first one. Do you have a lot of car loans, credit cards, that sort of stuff? Banks would like it better if you sort of got rid of those before things get really tight for them. So that's personal debt load. That's something we can all look at and start to manage. In terms of investing, I use a term called profit and protect, which I think sums up very well where we are at the moment. Because there's still upside in markets now, John, both in real estate and stock markets. But you certainly don't want to go heavily into leverage at this time. Because when it snaps back, you're going to be the first casualties that banks are going to start calling in those loans for, So you need to be very careful there. But I'll end on this one as well. If you're heavily into property and you've bought in good locations, well, here's a fun fact. A good location is just that in the good times of the economy and also the bad times of the economy. And so unless you have an extremely compelling reason, I don't know, say you're going to retire and you're going to cash up, that's fine. But if you don't have a compelling reason, PSE is not advocating that you go full on sell everything and, exist in a tent or something and then come back into the buy. Don't do that at all. A good location, good yielding investment property actually represents an excellent stepping stone for you personally to take advantage of your timing and start moving back into the markets when this current cycle bottoms and it turns around. Now, most people, I guess, aren't thinking maybe that far ahead, and I understand why. But these are the considerations I feel that our members at PSE we're going to be highlighting to them. And right now, when it's the calm before the storm, is the time to think dispassionately and with no emotion how you're going to play those out. If you have, an apartment or something that's not really going to yield very good returns in a down session stuff, then yeah, if you want to sell it now, go for that. Consolidate your portfolio, get rid of the worst performing assets that you've got. But certainly don't sell your own principal place of residence. Don't sell unless you have to places that are in top locations, because those locations will still be desirable even during a downturn. And they provide an outstanding platform for people, if they understand their timing, to take full advantage of the next cycle when it starts as well.
And if we look at the GFC as an example where there was that correction and credit was a little bit hard to get, and we did see investors, have a period of struggle, there definitely were those people that were ready to buy when that cycle changed, and they were getting great deals. So I think it's great for people who haven't seen these cycles before to get a better understanding of them and know where we are in the cycle. I know that Australia and America might be very different in their volatility, but there's still that cycle, and knowing it can give you so much power, especially if you are planning on buying when it starts to turn around.
Yeah, I agree. just having the timing just brings a large sense of calm to you. And it informs better investment and business decisions as well, because you understand the landscape of the economy. You can actually see how the economy times itself. That's something that we're very big on teaching. That's what I try to teach in the newsletter and the Boom Bust Bulletin as well. It's being able to see through the news to what's actually driving things. And it's almost always the land market. And if it's a land market, then it can be timed.
Interesting stuff.
If you were giving a top tip to a property investor that hadn't seen a cycle before, and they were maybe wanting to ask, what would my thing to do be to prepare for this cycle? What would your top tip be for an investor that hadn't seen these cycles before?
Well, if you're a residential commercial investor, it would be slightly different because historically commercial property tends to sort of outperform residential when we get near the peak. I'll give an example here in Australia. Go and look at what data centres in Sydney and Melbourne on the outskirts are bidding for the proper industrial land that suits data centres. I mean, you're going, I don't know, the average in Melbourne's probably about $300 per square metre. Microsoft and Amazon come in and double that. They'll just completely blow the competition out of the water. And you've got real estate companies like Collier coming out and admitting, yeah, actually, this will increase land values. Hello. But yeah, back to your question, Rachel, and it's a good one. So a top tip to sort of prepare. You've got to stress test your portfolio. If you're brand new to investing, I would say arguably buying an investment property now shouldn't be your utter priority, even though we advocate that you should own some land. But if you're trying to buy your own principal place of residence, really there's only 2 times every 20 years where that's probably not advisable. And we are approaching that. But right now, if you wanted to buy your own principal place of residence, it's still fine to do. But just understand that you're going to need to have a robust plan in place to either put more than the normal deposit down or have the ability to very quickly build up equity in that property when things turn down so that you can keep the bank on your side. So my answer to your question is it all comes down to debt. There's no new way to go broke. It's always too much debt. So be very cognizant of how much you're taking on and take the time now just to review your own personal investment debt load and see if you can work out some simple but effective ways that you can minimise those debts now.
So you mentioned about the debt levels, and totally get that. The higher we're leveraged, the riskier it is. What's the risk of having an investment property rather than an owner-occupier through this time if A, I've got the yields, and B, I can repay the mortgage each month? Like the bank don't come and knock on my door just because I've lost 5% in valuation.
No, the bank won't knock on your door until you're in arrears substantially.
Yeah. So if I'm always paying my mortgage on time, I'm never in arrears, what's the risk of whether it's an investment property, an owner-occupier or commercial?
Well, if you're geared 110%, and you have a 5% drawdown, you're getting a phone call from the bank, whether you like it or not, you know.
I've actually never seen that happen.
No, I haven't either.
In my 20 years of lending.
It's
Unless it was
more,
a commercial property.
If it was a margin loan, different story.
Yeah, it's something that can happen at this stage, the very late stage. I've seen it happen in the UK and the US where they're offering those mortgages and additional. So it ends up being like 110, 105, 120% sometimes loan that you can get for properties and stuff. That's part of that mix of that real speculative sort of fever that, that takes over. But no, I think, a 5% downturn won't see your bank put repossession notices in your mailbox at all. But you start to think maybe if you want to hedge yourself and you're an investor, have a look at the rent that you're charging, the quality of tenants that you have. And maybe what you might want to think is maybe for the next few years, possibly extend a longer term lease to a good tenant just to keep them in place and just have a nice income floor to your asset property as well. Because a lot of people are going to be doing things very, very tough. It's no guarantee that people can afford the rents that you may be offering during a recession. And certainly an investment house that hasn't got anyone in it isn't yielding any income. And that puts pressure on your own cash flow then to be able to step up and manage that mortgage. And as I said before, I think now in the calm right now is the time to sort of game plan this sort of thing and think about, what happens if a tenant has to go? How would we replace that income or replace the tenant with someone who's equally as diligent with their payments, looks after the property like it's their own, that type of thing. So it could just be, if you've got good tenants, maybe, in the next year or two, sound them out about, would you like to have just a, 2 or 3 year lease with optional, rental reviews at the end of that 12 months. And, if you're doing it tough, we'll just keep things there. That's just for me, just a simple option that I would look to do myself across my portfolio if I felt that, I was in an area that was going to suffer particularly badly.
Yeah, that's an interesting theory.
I think the other thing is the interest only versus P&I.
Yeah, that's another one too.
If we've got 4 properties and they're all P&I and all of a sudden I've got a bit of a credit crunch in my life, then we're going to be exposed or a little bit higher risk. So can we just look at mitigating that by having some interest only options?
Yeah, and then you come to the contractual repayments. So, you talked before about the bank. The bank will only ever get involved if you're in arrears of your home loan. So if things do get a little bit tougher and if we are heading into something, my advice for someone who'd be planning for that would be to look at your minimum contracted repayments and maybe stretch those out now while things are easy, but then you can always pay more.
That's
but
right.
That contracted part is the only thing that's going to come into play if things do get tough, if you're behind on your contracted repayments. So, interest only might be a great idea.
Yeah, and just having those offsets or redraws, having surplus funds in them so we can draw upon them when S hits the fan.
I was thinking about that too, actually, John. I can't remember, but I was sure I could recall back in 2008, 2009, etc., that certain banks, I don't think it was the big ones, I think it was the shadow banks, the non-traditional ones. If you had an offset account with them, they actually froze it for a time to make sure that they constituted the equity they needed to backstop the loans taken against the property.
It was a redraw, not an offset. But yes, there was a case of that, 100%. But it was redraw, not offset.
Yeah, I'll have to relook at that as well because that's quite possible that may happen again. I think that would be useful information to tell, for instance, our members and your guys as well to have a think about that as well as a possible obstacle over the next few years.
And I suppose it's timely to mention that I don't look at a bank contract when I sign it and say, yeah, give me a loan, I'll read through the terms and conditions. But what's in there is an all monies clause, isn't there? Where they basically say, well, we've got access to your money and if push comes to shove, we can take that money to pay down some debts if we need to. Now, does that get used? 99.5% of the time, no, that doesn't need to. If we continue to pay our bills on time, they leave us alone.
Yeah, I don't think there is the all money clause in most lending now. It's just they can only take what's secured against that property. They can't come and take other things.
I must have the wrong contracts.
Yeah. But there has to be a default position and then they can come for you afterwards. But they can't just turn off your accounts or freeze your offset.
So a lot of the all money clause has been taken out?
Yeah, so if a bank holds 2 properties of yours, they can't just go and sell the other one because you're defaulting on one. They could come to you personally afterwards, but they don't just get to choose.
Yeah.
Yeah, our big banks, I think, they're very well capitalised at the moment. They have, for the most part, good oversight from APRA on what they do. They've got adequate capital buffers, as far as I can tell at the moment as well. They are actually well positioned to ride out a decent fall in land prices generally. The worry for me is what we call the shadow banks, the non-traditional lending. And this time, we've seen data, which I showed to my members a few weeks ago, in fact, from the RBA, very, very deep in their research, that showed that lending from the private credit is now almost equal to more traditional bank lending when it comes to residential home loans. And that's a concern because they're not very transparent at all, because they have no reason to be transparent. They exist where they do because there is less regulation. So out on the margins, when something really breaks, that reverberates through the system and really starts creating a tsunami of defaults throughout the financial system, I would not be surprised at all that it's one of these mobs out there that has a large group of bad debts. It's all based on trust, isn't it? If you don't trust that that person you lent to can pay for you, you call in the loan, and if they can't pay it, it reverberates. So that's my concern. But I think the big banks here in Australia, just from my opinion, I think are well positioned at the moment. Now, that could change in the next 12 months. They could go on an absolute lending frenzy, reduce those buffers right down, and then you're starting to question, just how well stocked they are for what's coming. But at the moment, I think that Australian banks are well positioned. They've learnt the right lessons from the so-called GFC.
In the back of my mind is always the Warren Buffett quote: "When others show courage, I show fear. When others show fear, I show courage." So I think we've always just got to I don't think there's alarm stations right now. I just think we've always, as investors, we've got to be always eyes wide open, don't we? And we've always got to be looking in our own backyard first with our foundations of our life that we mentioned before, and just expecting something to come upon us that is like a little bit of a brick in the road, where we say, okay, we can navigate through that because we forecast it or we plan for it.
And I think investors will hear a lot of different theories and a lot of different opinions. And, you take from that what you wish to. But I think one thing is true, that you need to be prepared for things to change, and buffers and savings and shoring up your lending is important. And maybe like Darren said, if there is something that's not performing in your portfolio, maybe consider it.
Flick it. Yeah. If you wanted to increase your knowledge in this space, there's and Kathy got me onto this quite some time ago. There's a book called 100 Years of Land Value in Chicago by Homer Hoyt. Now, I don't know about you, Darren, but I've found this really hard to read. Lots of pages, small writing, unbelievable amount of content in there. So I did skim through that. Secret Life of Real Estate and Banking, Philip Anderson, great book. Boom Bust, 2010, Fred Harrison actually predicted the GFC. And then probably the latest one, which I've found the most benefit from, just because it's probably brought all that together, is Akhil Patel, The Secret Wealth Advantage as well. So, yeah, there's a lot out there. There's a lot of information that you can consume if you're really into this. But hopefully today we've given listeners just an insight into I suppose another perspective, because a lot of media outlets, a lot of marketers are out there at the moment saying, wow, how good's this? Interest rates have just dropped once again, and we can obtain all this lending from banks, and let's go and buy. But you've got to be very careful as to what you buy.
Yeah, market tops generally won't happen until we're all in. And to get everyone all in, we all need to feel very good, happy, and secure about the future, and that's the great trap, and that's what's starting to build now. Particularly if you're involved in crypto as well, there's just no dissenting voices are seemingly allowed, which is a massive alarm bell for me personally.
And that's what they call the winner's curse.
The winner's curse.
That's it. The mania phase. The mania phase. That's we have a property clock on our website. So if you go to propertysharemarketeconomics.com. It's dominated by a clock, and that clock has an inside 12 hours and an outside, so it makes up 24 hours. So at the moment, our clock is at 2 p.m. And if you hover your mouse on the clock, actually, it gives you a brief description of what each hour means. But yeah, we are in what we call the winner's curse. We sort of call it that because if you win at that auction and, you've bid $500,000 over the, expected asking price you wanted to pay, well, now you're cursed because in a few years' time, when things turn over, you're going to be in all sorts of strife. So we tend to call it winner's curse, and it's a exercise in opposites, where there's things that you should be doing now, which are actually contrary to things you're reading or hearing, or in fact the general mood at your average barbecue or down at the local pub and the things that people are talking to. They're all signs that things are starting to get a bit toppy, a bit frothy here. I need to take a step back and actually start to do the opposite to what everyone's doing. So mania phase of winners, because I think it's an apt name for it.
Very good. Well, appreciate you coming on today, Darren. Any final insights for our listeners today?
Oh, look, if you're interested in land economics or the real estate cycle, come and peruse our website. There's no obligation. Have a look. We do offer a free weekly newsletter. You can sign up for that on the website. There's no ongoing obligations, just your email. And for your viewers in general, look, you've got time. The best sense right now is common sense. And if you do the preparation now, then you'll do fine during the downturn. You'll wear it out. You'll be emotionally attuned to block out all that bad news. And with luck, if you know some time, and you'll actually be able to prepare and come out of the wreckage in a much, much better place than what you went in.
And that's the thing, like it's knowledge and mindset, isn't it? But and I think the positive of this is if you stay cash heavy, you're appealing to the banks, then on the other side of it, you've actually got more leveraging power to be able to go and take real advantage of this as well.
Thank you,
Rachel,
Darren.
John, thank you very much. It was a pleasure. Great questions and great company. Thank you so much.
All right. Bye.